Are you paying attention to Jackson Hole? Are you watching what all the insiders and the billionaires along with the Fed are doing and saying? You should, because it had a pretty big effect on the market today. Powell came out and spoke, and the market did a complete 180 and turned around and rolled over. Folks, welcome to Your Money Radio. We're going to talk about that and quite a few other things and how advisors are responding to bear markets. And then Michael Ramos' leading sector this week. Last week, he was talking about natural gas, which has been doing very well. And this week, he's going to talk about another, actually, it's kind of a subsector. It's very niche, and it's the supply-demand picture looks very good. But we'll talk about that a little bit later. We've got lots to cover, so I'm going to dive right into it. And we've got a few topics. The first topic I want to cover is I ran across this article of 4 ways advisors and clients are responding to bear markets. Okay. Oh, sorry. I'm out, Zach. I've got to do the disclaimer. All right, folks. If you need this show is meant for entertainment and research only. It's to give you information to go check out on your own. If you need individual specific investment advice, either reach one of us at Revere Asset Management, just revereasset.com, Don or Michael at revereasset.com, or you can call us at 855-REAL-WEALTH, or you can talk to your own advisor. Hopefully, though, he's not one of these advisors that falls on number one. 68.4% of advisors recommend staying the course. Buy the pie chart and hope it doesn't go down too much. Just hang in there, baby. And 80.4% of clients are doing just that. So about 10 to 15% of more clients are not listening to their advisors, and they're just doing it anyway because they're scared and they don't know what to do. They freeze.
Well, they have advisors.
Then, number 2, 25.5% of advisors are recommending buying the dip. Only 8.7% of the clients are doing that. Again, because they're afraid. And the time to buy, it's one of the hardest things to do is buy when it's blood running in the street. That's one of Warren Buffett's favorite quotes. And the other thing to do is to aggressively harvest profits when they're up, because you extrapolate and think things are just going to keep going on. Number 3, selling equities and moving to cash. Only 2.6% get defensive. Man, are we in the minority? Okay. Only 1.8% of clients recommend doing this. So I guess the other 98% of the clients are miserable and scared to death. They should be. All right. Number 4, not selling, but pause on new investments. 2.6% of advisors recommend. Only 1.8% of clients are doing. Now, really, it's just the opposite, folks. When it starts getting ugly, when you see things triggering and starting and you need to get defensive, you need to move to cash. But then, because the principal, the big lump sum is much more important than the little dollar cost averaging $500 or $1,000 a month. So on big sell-offs is really when you'd want a dollar cost average just the little bits in. If you're going to do it, you don't want to do it near market tops. You probably want to pause it then, but that's counterintuitive. That's how you know people manage money emotionally. That's how you know it's wrong. Follow the herd. You don't want to follow the herd. Or should I say lemmings? Yeah. Okay, we'll talk. We're going to wrap all that up. We're going to talk about that with Don when we do, and Michael when we do the other topic. But that article is in the show notes, so you can read that article that talks about these client behaviors, right? And we'll talk about all that and encompass that when we talk about the single stock ETFs in just a few minutes. But first, I want to do the mailbag. I'm going to toot our own horn and Don. And then, Don got a really nice email. So this is a new client that came on board. He's very active. He manages his own money for decades, and he's kind of come up with recognizes sectors and stuff. And he actually helps friends and family, helps other people to manage money. But it was time to him to retire, and he brought over himself and some friends and family. Yeah. But anyway, he says, these past few months have been extraordinary learning opportunity for me, as I have watched how you got in very early in the rally with SSO, adding progressive exposure as we passed the moving averages. that one takeaway has been huge. But that is just one of the many observations I have had and have internalized for my own trading. Okay, confession here. I have selfishly enjoyed having you do the recap each evening. What a pleasure to have the master teach. But I know we will need to bring young Michael, in parentheses, not Alex, if you want to learn that's an inside joke from a few shows ago. Young Michael along. It will be interesting to watch his brilliant mind start to lock in on what is really important. You and Dan have been an incredible blessing for my family and friends. Thank you for all the training and effort you did over the years to bring your skill set to this level. And thank you for managing your life in such a way that you can be clear and level-headed day in and day out. That takes daily discipline and is not easy. Wishing good things for you and your family. Okay.
Wow, kind words.
So that was a very good one.
Yeah.
Okay. And we like that. Now, I've got another one.
Oh, no.
This is segueing into the single stock ETFs and ETFs in general, and kind of a broader discussion of the first topic, what these investors are doing and how to handle this market.
Yeah.
Because today, right now, as we speak, it's about a little after
10:41?
10:41 Central Time, and there's blood running in the streets in the market because the Fed came out and spoke. But so Uncle Tony is a longtime listener. He's a great friend of the Revere, but he also is an avid trader, and he's an IBD. He does IBD. He lives Investors Business Daily methodology. He's one of the and we call him Uncle Tony.
Yeah.
And he is a purist, meaning he only likes individual stocks. He hates ETFs because he thinks you average and you get the lousy with the good, right?
Yeah.
Okay, so I'm going to read this very quickly. ETFs always, let me start over. ETFs always suck. Always. Well, over time, they always suck. Yeah. There will always be periods where even the best stock catches a cold. However, all ETFs are averaging devices. Some stocks will do well, other will have the flu and die. Costco only underperformed the particular ETF he's talking about, the consumer ETF. Costco only underperformed the ETF in one narrow zone. That was May, when the market decided all retailers were the same. When Walmart reported bad numbers, Costco flopped. As soon as Costco recovered their great numbers, it recovered very quickly. ETFs actually caused this linkage, another part of their evil existence. And he says, I did a comparison with the Consumer Products ETF XLP over last year. All the stocks are shown, and he showed Costco was up 20%, not counting a small dividend. Coke was just under 15. The ETF is up at 5, only 5%. Procter & Gamble, the largest block in the fund, is 2% plus a 2.5% dividend. So that makes it okay. That's sarcasm. Walmart is down 10%. Estee Lauder is down 20%. Why on God's green earth would you buy Walmart, PG, and EL? You wouldn't, but you do when you buy the ETF. You can use the ETF to track the direction of a sector, but please don't buy this steaming bad thing. Okay. Now, he's a little outspoken.
Choice words.
So, and he's got a point. Now, it's a lot easier to look with hindsight, looking back and looking at the stocks in the sector and what they did.
Always 2020.
But I said, playing devil's advocate, some sectors and even subsectors. I'm sorry, I missed a paragraph. Yeah. My response, Uncle Tony, I agree with much of what you were saying, especially the diversification of bad to get the good. And some sectors are simply too broad with different companies and business models that the companies diverge greatly, like your example. So in other words, this consumer products have all different kinds of stocks blended in there, and they're vastly different. I mean, I don't compare Estee Lauder really with Costco. Those are two different sectors and business models, in my opinion. So that's pretty broad. But anyway, some sectors, right. But here's what I said. But I said, but one still has to be a good stock picker and sift through lots of companies to identify the winners. So look, guys, it does take a lot of time. I mean, being a good stock picker takes a lot of work, a lot of diligence, and you really got to dive deep. Some retail investors are not going to do that much research, and they're busy with their own lives. So in that sense, an ETF is a tool with diversification. So I said, playing devil's advocate, some sectors, even subsectors, can be more precise and you get the benefit without having to pick the right stock. This would also allow you to take a bigger position exposure without being top heavy in one stock. This is especially true. Where lost my train of thought. This is especially true when you've taken defensive action and now are heavy in cash during a big correction or even bear market, and now you want to get back in the markets. While identifying new leaders, because the worse the market was, the fewer leaders you have on your watch list, because everything looks bad, right?
Yeah.
You can get sector or even broad exposure while you are picking up individual names. So it helps not having cash drag when the market starts to rebound. This will reduce cash drag right after a deep decline during the initial recovery. As you keep adding, you can reduce the exposure and make room for your new individual stock positions. Also, leveraged ETFs and inverse ETFs can play a role in the overall portfolio management. But I will say that there is nothing better than a purist picking the right stock that's working, and that would be in a primary uptrend. Okay, lastly, now this is going to be our second topic du jour we're going to talk about. Lastly, these new single stock ETFs are interesting as they are leveraged or inverse on a single stock. Why personally, I would simply increase my position size if I'm long that stock. There are inverse ETFs that may be very valuable. So if you have a big legacy position you were trying to hedge, or in the short term, these might make sense. Although I still haven't seen the regulators or IRS take on whether this would be akin to shorting against the box. That was when people would be long a big position they inherited and they just short that exact same stock. And the IRS came in and said, no, that's a constructive sale. We think you sold it. You owe the capital gains tax. Okay. So the question is, will that be disallowed? And we'll talk about that in a minute. But if it is acceptable, it's a great way to hedge large positions that one doesn't want to sell and avoiding capital gains. It would also be a good way to short individual stock positions in an IRA. So up till now, with an IRA, you had to use a sector or a broad ETF, inverse short selling ETF, to be able to. But if you see a stock that really looks ugly on the chart and it really looks bad, you could actually short that individual stock inside an IRA, because you're not allowed to short in IRAs. All right. Now, and I said, as an example, Tony sometimes employs a covered call strategy to generate income. I said, with covered call strategy, especially large positions during tumult, you could use a single stock inverse ETF to hedge your position, so you don't have to unwind the stock, and you can still do the covered calls. You can still clip the premiums. So anyway, that was a whole lot in one. So I want to hold off on the the individual ETFs, because we'll talk about that in a minute, Don and Alex. I do want to combine the use of I want to talk about the use of ETFs and portfolio management with Tony's idea that all ETFs are bad. You need to do just individual stocks, and the first part of the thing of what these advisors are doing, staying the course, not getting defensive, whatever. So it really is, how do you manage in this choppy, volatile market?
Right.
And also, should you be using ETFs? So that's pretty broad, gives you lots of room. Don, why don't you kind of weigh in and comment on that?
Well, I think it was Mark Twain that said, lies, damn lies, and statistics. And Tony wouldn't have sent that email at the end of May. Now, he mentioned May as a period of underperformance, but I will show, Zach, if you show my screen, this is the comparison chart that Tony sent along with his email. Picking the 1 year period from 8/24/2021 to 8/24/2022. It conveniently shows Costco up 20% with the XLP up 5.8%. Lies, damn lies, and statistics. I'm going to pick a different time frame. I'm going to pick the 2-month period of 3/31 to 5/31. This shows Costco down 19%, the same Staples index down 2%. Now, the argument that if somebody was looking at this chart would say is, why in the hell would I ever want to take on the single stock risk of Costco when I could own XLP and only be down 2%? So time frame is important when you're discussing these situations. Even more important is to take a look at the overall chart. There's times when Costco is going to be healthy, and there's times when Costco is going to be unhealthy. And I'll revert to our 3 time frames that we always talk about: short term above the green line, 21-day exponential moving average, the red line, the medium term indicator, the 50-day moving average, the black line, the 200-day moving average. That's the long-term indicator. Costco's above all 3, no problem, hold it, enjoy your profits. Costco starts breaking down like the entire market did mid-April, breaks the short term, breaks the medium term, and then breaks the long term. There's no way in hell I'm holding Costco, even if I can sell calls against it and even if I can collect a dividend when it's under the 200-day moving average. And that's just one of my rules. And I just showed a chart that proclaimed my confirmation bias of when to hold and when to not hold a single stock versus ETFs. Let's go a little bit further and show looking even worse. Let's go for 2022, and let's pick the exact bottom. Let's go 5/20/2022. Because the long term is made up of a bunch of short term and intermediate terms. And here's Costco down 28% while the XLP is down 7%. So if you want to take a 28% haircut in something that you own, be my guest. I'm not going to. The bottom line is that individual stocks will underperform or outperform their broad sector that they're classified under, depending on market conditions. And that's just a fact. Can't argue one way or the other that one's better than the other, because no matter what time frame you pick, I'll pick a different time frame proving my point that goes counter to your point. And then you'll say but, and then I'll say but, and then we'll just end up agreeing to disagree. But one thing you can't disagree with is the price action across short term, intermediate term, and long term. And that's how we manage money here at Revere.
Well, so that's a very great point. And so that actually is a perfect segue to talk about, timing is everything. Timing is important, right? And like Bill O'Neill and IBD and the IBD methodology and the stock purists, kind of like what Tony's talking about, leading stocks will make you the most money in a strong primary uptrend. They're better than ETFs. We got that. We agree with that. Okay. Now, but did you know, but the average stock, the average leading stock, the best of the best, when you enter a bear market, Don, how far does a leading stock fall on average?
72% top to bottom.
And most
on average.
And on average, some are more, some are less. So if you look like in the beginning of this year when tech fell out of favor, some of the best tech stocks in the world fell 40%. 40, 50, even they didn't fall some did fall that much, but some didn't. So the point is, there's a time for these leading stocks and there's a time for the sector ETFs. Now, the one other point that I made was, like in a narrower niche, like just the semiconductors or just the solar or something, it's more of a narrow subsector, if you will, and it's a little bit closer. You're going to get a little more. I mean, it's still averaging, but you have a smaller universe, and you don't get such a wide diversity of companies like you do in that consumer company. So
that happens very often in gold stocks and oil stocks also.
Yes, gold ETFs.
You get very strong group moves within, and of course you can pick the winners between them, but you can also pick the sector itself for a little more diversification, less single stock risk. The point is you're trying to outperform the market for a certain amount of risk that you're taking on. You can outperform more with more risk or less with less risk. And It's totally up to the risk appetite of the person making the decision.
Well, now another thing along those lines, we manage portfolios by dialing up and down the risk on how much risk is in the market. See, people's risk tolerance is important because they'll get scared and they'll get shaken out. But in our opinion, in Revere, the risk of the market, the sector, or the stock itself outweighs my personal risk. Because you know why? Because my risk tolerance changes over time. When it's hitting the fan, everybody turns into a wimp, right? When the market's going up, FOMO kicks in and everybody wants in. So even when a client fills out that risk tolerance questionnaire, I take it a little bit with a grain of salt because I know that their appetite and mood is going to fluctuate with what the market is doing. And that's why you want to adjust the portfolios constantly. Don, can you very quickly hit on how you use the leveraged and inverse ETFs in overall portfolio management? Right there, we were talking about making money in a stock or a sector, theoretically going long. Let's talk a little bit about the broader index ETFs, both long and short.
Right. So when we re-entered the market, we exited the market on January 24th, which was this break below the 200-day moving average. If you follow us, you know how I feel about the 200-day moving average. It's the black line here. Every bear market, including every severe bear market, takes place once you get a weekly close below the 200-day moving average. This is a chart of the S&P 500. We went up and down a little bit versus the 200-day moving average, but the big change happened on April 21st when we tried to get back above, had a very negative move below, and then we just continued in a free fall over the next couple of weeks. Common theme is that we were below the 200-day moving average. This is when we're in bear market risk territory. So the market is risky. These are the stats of the last 13 bear markets going back to 1968. We bottomed this January to July bear market 24.5% off the highs. So we need 32.5% to get back to even. Worst case scenario, let's take the average of the 6 bear markets. They're down 44.5% top to bottom. To get back to even, you need an 80% gain. Usually, once we top out and we come down and break the 200-day moving average, the move from high to low is approximately 8%. If you look here where our highs were, it was actually 9.2%, but normally it's between 8 to 10%. That's how far above we'll start until we break the 200-day moving average. And 8 to 10%
the markets, the indices,
the market, correct, the index, 8 to 10% until you break the 200-day moving average, and that's when risk picks up. So once we're under the 200-day moving average, we then look to see where we are relative to our intermediate term average. That's the red line. That's the 50-day. Where we are relative to the short term, that's the green line, the 21-day. This entire period, we're trending lower. We're as defensive as we could possibly be. Get back above the short term, we're going to take a little of risk on. But anytime we dip back into the water, we're not going to risk more than 2% of the overall portfolio before we would get stopped out. So we're position sizing to manage to that. And if we start making gains, we'll put a little bit more risk on, but always with a negative 2% risk to the overall portfolio. Sometimes you'll get stopped out quickly. Sometimes you'll make a little bit of progress. Sometimes you'll make good progress. When we went back in on 7/15 of this year with a move back above the 21-day moving average, we got a very strong run off the bottom up until we hit this. What level is that? The risk level, the 200-day moving average, our long term. So we hit there. We started taking some risk off. We got back below the short-term moving average. In the past week, we started taking more risk off. Yesterday, the market was seemingly trying to front run Jerome Powell. They had a nice move back up through the 21. We put more risk on. This morning we had complete opposite, a very harsh reversal to the downside after his speech at Jackson Hole. So all morning we've been taking positions off as this appears to be a change in character for the market, at least in the very short term. This move back below this green line, our short-term 21-day exponential moving average. So Those are the trades that we've been making all morning. What we first do is take a look back at what our most previous buys were. And if they're red, we cut them. Our most previous, the two buys that we made over the last 2 days, plug and PANW, we cut them for small losses. The prior buy to that was we increased our SSO position. And we took that back off because it went negative when we broke back below the 21-day moving average. Now, SSO is the key tool that we use. Dan's question was about double ETFs. We like the risk reward of being able to use half the amount of capital that we would use with SSO versus just buying the S&P 500. I like the S&P 500 because of the diversification inside of it. It's got 11 broad sectors. Granted, they're weighted differently, but there's half value, half growth. So when the market on any individual day decides that growth is going to perform or value is going to perform, all that rotation takes place within the S&P 500. So you don't have to guess which sectors are leading and which sectors are lagging. All it is a bunch of money moving around between sectors. But the progress of the overall S&P 500 continued to trend higher. So we use the SSO to get our initial stake. And then in this case, we over 20% gains up to the top here on that position. We got up to a 20% consistent position size. So that's a 4% gain to the overall portfolio. And then during this run, we were also adding individual stocks, which were outperforming the market. Some of them didn't work. We cut those very quickly. We don't want to lose ever more than 0.2% on any individual position that we take. So we're always cutting our stops. We realize that really it is just a game of numbers, a law of averages, and we know that as long as we keep our losses small and we let our gains run, that we have a 50-50 batting average, but we make twice as much as we lose. And that makes our system long-term net profitable. So cutting the losses, letting the gains run. When the gains start to come back to certain levels, you take the profit, you take your profit, you cut your loss, and wait and see how the market unfolds. We could very well continue to make newer lows this summer or as we enter the fall. We don't know. What we know is what's happening today was a very negative reaction to what Jerome Powell said, and we're positioning accordingly by wrapping up profits, cutting losses, and reducing our exposure to the market.
Okay, I do want to clarify and not necessarily correct, but clarify something you said. You said when you take an individual position, you'll cut your losses very quick so that you don't have any more than a negative 0.2%. That's against the overall portfolio. He's not talking about the individual stock. So if the stop gets hit at 6% on maybe a little more volatile stock, it's, you adjust your position size of each stock. So a more volatile stock, you need to give a little bit more room because daily trading could hit your stop, but you take a little smaller position. For a little less volatile stock, you can put your stop a little close. It's a bigger position.
Right. A very volatile stock, we can take a 2% position and a 10% loss on that. And that's a 0.2% hit to the overall portfolio. A stock that moves slower, we can take a 4% position in and take a 5% loss on that. And that's the equivalent, the same equivalent, 0.2% to the overall portfolio.
So the big question is, are you at home, are you the listener, are you guys doing that and managing your position sizes properly? Not only your position sizes when you buy them, but then you've got to have we call it a beta adjusted stop loss. It's a little more sophisticated than just beta, but it's an adjusted stop loss based on the volatility of the stock. Okay. All right. So let's go a little bit further. One more thing that article that we came across, I think Michael or somebody may have found it and sent it to me, and it's talking about the midterm seasonality and the potential for markets to rally into, into a recession. We're going to a recession, but it's saying what happens to the midterm.
Right.
Well, the 12 months prior to the midterm, the return is only 0.3%. Historical average is 8.1% annualized per year. That's the long-term average of the S&P. However, 12 months post-midterm, it's 16.3%. And it's especially true for the 3 and 6 month periods right after. So the strongest time is right after the midterms. 3-month average is 7.3%, and 6-month average is 15.1. It was kind of funny. They had a little caveat that if you took out the 60s and 70s, then the prior 12 months before the midterms is actually closer to, it's like 8%. It's right close to the historical average. And those were choppier. Again, they're kind of cherry picking and mincing words. And that article is in our show notes. The only reason I bring that up is people can get down and negative on the economy. And if we're going to recession and the Fed's raising rates, and they can get it in their mind that the market's got to be terrible, and you could actually have a big rally. And likewise, things could be looking up and we're kind of pulling out of a recession. The market's already had a rally. They kind of front run the recession, and you could have big institutional money taking profits. So as you recover, you may actually get a correction in the stock market. So you've got to separate Main Street and Wall Street. Both of those articles are up there. I don't think either you guys want to comment on that, right? I was going to go to Michael's hot new leading sector that he's bird dogging. Is that okay, guys?
Yeah.
Sure.
All right. So Michael, last week, Michael, he loves doing a deep dive in fundamental research and loves finding, either supply demand disruptions or whatever fundamental things make the story really strong and give a sector or a stock the impetus to move a lot higher, even in tougher markets. Last week, he talked about nat gas, and natural gas has been doing very well. So this week, Michael, what are you going to talk about? Let's hear it.
Silicon Carbide. So what led us to, or led me to do more research on Silicon Carbide and figure out what's going on is the charts. A lot of these companies that are involved in the space have been performing very well on a relative strength basis. They are leading and they're outperforming the market. So when a group is really taking off and doing well, it's always wise to see what's going on and look a little further into it. So I was tasked with doing some research on Silicon Carbide and why this market is performing so well. So I've got some fun information for our listeners today. So just quickly, I'll just briefly describe, Silicon Carbide is naturally called moissanite, and it was discovered by this guy Henry Moissan in 1893. And it's essentially it's very, very similar to diamond. So it's an extremely hard and durable material. It's very rare to find naturally. So there's companies now that make this compound called silicon carbide, which is the manufactured version of
Synthetic,
moissanite.
synthetic,
And it's synthetic version of moissanite. So and moissanite is also used as synthetic diamonds, and it's used in jewelry. But the real use case for it, and the reason why these companies are doing so well, is because it's really important and it's critical for the green energy movement, and especially the electric vehicle space. It's used in EVs as so in electric vehicles, you've got battery technology and then you've got motor technology. And the way that motors are run is through alternating currents. And the way that batteries inject the motors with energy is through a direct current. So what these silicon carbide semiconductors do, the inverters, is that they convert this direct current, change it into an alternating current so that it can feed the motor more efficiently. And it used to be done with silicon, which also served the same purpose, but silicon carbide is better because it's a lot more efficient. Silicon inverters currently lose 20% of their power when they're converting this direct current to alternating current, and the silicon carbide doesn't have that power loss. And it's actually a lot smaller and can do a lot more in a small amount of space because of its durability and the fact that at high temperatures it doesn't expand as much as regular silicon. So they can decrease size and weight of these components, which reduces cost over time. And it's also critical in the way that these fast chargers can actually charge the batteries with a silicon carbide inverter to charge the electric vehicle. You can actually cut charging times in half, and it's a lot more efficient, effective, less loss in heat, which results in more power. So overall, it's just better for the industry. And there's two companies that I'd like to mention. There's onsemi and there's Wolfspeed. And I guess we'll bring up Wolfspeed first, ticker WLOF. Don, if you could bring that up. Perfect. So Wolfspeed, there we go. Wolfspeed had a big gap up on earnings, and the reason for that is they're the silicon carbide market in 2019. There was a report that it had it valued at $460 million and was projected to expand to 1.5 billion by the year 2027. But new reports actually that came out in 2021, so just 2 years after that $460 million valuation, the new reports measured the market at $1.62 billion, which was which is more than what the market was supposed to reach by 2027. So 2 years later, they had already surpassed those estimates, and now the estimates are projecting the market to grow to 5 billion by 2025. So this market is growing a lot faster than anyone could have anticipated. So the companies that are involved in these silicon carbide, um, either chips or actually manufacturing the material themselves, um, have just grown at a rate beyond surpassing analyst expectations. And what's special about Wolfspeed is that they're vertically integrated, so they actually manufacture the silicon carbide, but they also make the chips that they use the silicon carbide to make the chips. So they're what's called a foundry as well. And in the semiconductor space, foundries they're the ones who manufacture the chips. So Wolfspeed manufactures their own chips, but there's other companies that want to use this silicon carbide to make chips, and they have partnerships. So companies like Umbrella and different Nvidia, all these companies that make chips that go into EVs or your iPhone or your computer. They all Most of them don't have their own foundries, so they use companies like Wolfspeed. onsemi also manufactures the semiconductors, so they use these silicon carbide foundries to make their chips. They design the chips, and then Wolfspeed and onsemi make the chips. So that's something special about them. And I'll just mention one last thing. Uh, onsemi Well, yeah, I guess I mentioned it. Yeah, they have their foundry. They also they're involved in every step along the way. So there's a diagram in an article that Dan is going to post to this video, but it shows how silicon and carbide powders are placed in the furnace, and then the crystals emerge, and then they turn them into these wafers and slice them, and then they dice them, and then they package them in these. There's different. I won't get into the technicalities of the different kinds of semiconductor components, how they're made, and the different use cases. But they package them in certain little devices that can then be used either in the lidar for electric vehicles and the charging station, in your phone, in your tablet. Um, there's just an unlimited amount of use cases. And it's also involved in a big thing. So 5G technology, the last component of it that's really accelerating is 5G technology has now allowed for something called Internet of Things, where devices are now connected online, and they're constantly feeding information nonstop to, for example, your power meter at your house, where instead of the Department of Water and Power coming and checking your meter, a lot of these devices now through Internet of Things and 5G are connected, where they can be measuring that reading from a remote location, and that's all been enabled through 5G. And these semiconductor chips, the silicon carbide chips, are a huge component in that Internet of Things IoT communication. So as IoT expands and 5G adoption expands, all of these wireless communications will be powered by the silicon carbide chips.
All right. So, folks, let me make it real simple for you, because what he's saying is really important. You know, they used to call it Silicon Valley, right? That's what silicon.
There was a time
goes into every, from chips, from computer chips, NVIDIA to cars to silicon goes into almost everything technology.
Yeah.
Well, now I think they're going to have to rename it Silicon Carbide Valley. Because seriously, Silicon Carbide is going to be the replacement for silicon for most of the higher tech, because it makes it's more efficient, it's faster, and it's smaller. And with computers, everything, computing power, space and time and speed is everything. And so they're more efficient, they're faster, they last longer, and they're more durable. And so this Silicon Carbide is a huge, it is a big deal.
Yeah, better in every way.
It is a big deal. And they like it because, and also from the geopolitical standpoint, it's, quote, greener, it's cleaner. So they like that too.
Everybody likes it.
Everybody wants some Silicon Carbide.
Everybody wants some.
All right. So, folks, in all these articles, all these things that we've seen, you can read for yourself in the show notes.
Yeah, show description.
And I put a couple bonus things in there. We just didn't have time to talk about them. One was Robert Schiller, the Case-Shiller Home Price Index. He said real estate prices are likely to drop more. Thank you, Captain Obvious. I've been talking about that for months, but oh well. And then there's another article by Liz Ann Stonders from Schwab. She's our chief economist. She's saying that the market probably has another leg down, and she gives her fundamental reasons. But anyway, all of the stuff that we talk about on the show, you can do your own research. You can look down there. All right, very quickly, let's dive into the markets and talk about what we're seeing and what you're going to be doing and how you're going to be positioning heading into next week, Don.
Sure. I'm showing a chart of the 60-minute chart of the S&P 500, and this was the most recent breakout. This happened on 8/10, 8/11, and was considered really bullish. What we did, though, is run into this 43.25 area, was right where the 200-day moving average was. That's the black line. It's not shown on this chart because it's a 60-minute chart. So that was the question then was, are we going to go sideways? Are we going to go down? Are we going to break through back to the upside? We started pulling back, and then we had a big gap down on the 19th. On the 22nd. And then the question is, can that gap hold this 4,100 area, which is, we were going sideways here before we had that big breakout. So this 4,100 area is what's considered support for the market. The breakout prior to that was around 4,000. So now we just look backwards from the levels that we reclaimed on the left side of the chart to see if buyers can come in and keep the market above those levels. You can see today this big ugly line down from the 11 o'clock hour. This is when Powell finished speaking, and the market reacted negatively to it. Now, right now, we're holding this 4,100 area that is extremely important. The next leg down is to the 4,000 area if we break that. And it's also clear that we broke below this 4120 area, which was the prior support while we were going sideways and the market was trying to figure out what our next move was going to be. Let's go back to the daily chart here. Here's those market going sideways. Yesterday is a what's called a bull trap. Today is exposing it as a bull trap. In other words, the market moved higher above a key area and it stopped and reversed lower. So anybody that bought this breakout, this bullish breakout, is now underwater. And until we get back above this 21-day moving average, which is around 4150, this is considered a failed breakout. So like I said before, when we were going backwards, we just retrace our steps. What did we add on recently based on this bullish action? Are we underwater on it? The answer is yes. We cut our losses. So we sold Plug, we sold Pan W, and we sold the additional SSO position that we took on this break above the 21-day moving average. And now we're not going to predict the bottom is in today, or if this is just a pause on the way down, or if we're going to bounce, we're going to let the price action tell us what the next move is going to be. Right now, we're sitting at 41.04 as of 12:20 Eastern time today, and if we break below this 4100 area, we're going to be getting even more defensive. In other words, hedging the SSO long that we still have, and if it looks like we're going lower, we'll just wrap up our profits on SSO, and then we'll end up being on the short side as the market works its way lower, which means we'll be profiting from the market going lower. So anything that we're still holding, we've got gains in, we'll mark them and see where we want to take our gains. In other words, where our stops are going to be, we already have them in place. If they get hit, the market will take us out of the market, or the market will take us out by price discovery. We're not guessing, we're going by the facts, what the market's telling us to do. And we just move throughout the day doing that, look at the next day, see what our expectations are, see if those expectations are met or broken or exceeded, and react accordingly. Leading stocks so far are holding up very well. While the market's down over 2% today, the leading stocks that we own, Wolf is down only 1%, LNG is only down 1%, Exxon down less than 1%, and SWAV down 1.1%. So the leaders are holding up right now. That's the majority of our portfolio. And as long as that continues, we'll stick to our stops, possibly do some offensive selling if we think that the market's going to, I said think, I don't mean think. If the market looks like it breaks below this 4,100 level and it's going to head lower, meaning if you break 4,100 and you don't get right back above it, that's an indication that odds favor you going lower, and we react again. Not predicting, we're reacting. So we went from offensive yesterday to completely undoing that, and now looking at defense because we broke this short-term moving average, which was very critical.
Okay, and so folks, I'll wrap that up. Oh, go ahead. So
I'll update all this on Friday night's video.
Yeah, I was going to mention that. Okay, so what Don has just said there for the layman, not for the stock nerds, but for the lay person that doesn't follow it that closely. So we still have a hedge on, a small hedge, and then we've got some stocks that are still holding up. If the market continues to get weak, we will unwind those positions that we have left, and then the hedge can turn into a net short position to try to make money on the market going down. In other words, your hedge can actually turn into not a hedge anymore because you don't have anything left to hedge.
Right.
You're actually trying to make money on the downside. So in any event, folks, listen, Don does his 21/21 market insight video. We do a short market insight video every day the market is open, okay? And Don's 21/21 shows the 21 leading stocks. And it's kind of a weekly wrap up. It's good. All the videos, daily videos, are good. But if time is not your friend and you're really busy with family and you just got lots of stuff and you can't watch every one of our Monday through Friday market insight videos, the Friday one is, if you can only catch one a week. That is the one to catch for sure. But you could try to catch a few a week, and that will help. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com, and in the top right button, they can hit that subscribe button, put in their name and email address. We're not going to spam them. We don't sell our email list to anybody. It's up to them to reach out to us using the contact button. Put in your email address in the contact button, not ours, and send us a message, and we'll get back to you. We'll answer you back and give you a response on, if you're asking about the market or a stock, or you just want to find out about Revere and want to find out more about becoming a client. So it's up to the client to reach out to us. You can email any of us at dan@revereasset.com, don@revereasset.com, or michael@revereasset.com. If it's admin and paperwork and sign up, you can email Meryl@revereasset.com. You can also call us old school at 855-REAL-WEALTH. Folks, have a great weekend. Stay safe, and we'll talk to you next week on Your Money.
Barring any extraneous events or misconfusion.